The American economic empire is collapsing in real time, and what I'm about to show you proves Washington knows it. China just executed the most aggressive de-dollarization move in modern history. Canada received a warning so severe it's being kept from the public, and the yuan is now replacing the dollar in transactions worth hundreds of billions. But here's what nobody's talking about. The three countries that will trigger the final cascade are already moving. Stay with me, because by the end of this video, you'll understand why the next 90 days will determine everything. If you were watching your screens yesterday, it wasn't subtle. Red everywhere. Stocks bleeding, banks sliding, yields spiking at velocities we haven't seen since 2008. This is what happens when global confidence doesn't just crack, it fractures. The S&P suffered its worst single-day loss in over a year, dropping more than 2.5%. In one session, U.S. markets erased over $1.3 trillion in market capitalization. That kind of destruction doesn't happen in a healthy system. It happens when investors collectively decide that risk has fundamentally changed. And they're right. The biggest losses hit the most inflated sectors first. Overpriced technology stocks were hammered. But the real warning signal came from somewhere most people weren't looking. The banking sector. Major financial institutions fell hard. One of the largest U.S. banks dropped more than 3.5% in a single day. That's not normal volatility. That's the market pricing in systemic stress. It's as if investors are already asking a question that should terrify policymakers. If global capital begins flowing away from U.S. assets, what role do American banks even play in that future? Because banks don't exist in isolation. They sit at the absolute center of capital flows, trade finance, bond markets, and global liquidity. When confidence in the broader system weakens, banks become the first pressure point, the first domino. And here's what makes this moment different from every other market sell-off you've seen. This isn't about one bad quarter. This isn't about inflation data or interest rate speculation. This is about something far more fundamental. The architecture that has supported American financial dominance for 80 years is being deliberately dismantled, not by enemies, by allies. The empire isn't being conquered, it's being abandoned. And Washington's response tells you everything you need to know. When senior U.S. officials start publicly warning allies, not enemies, not to retaliate, not to respond, to simply absorb economic pressure and stay loyal, that's not strength. That's panic disguised as diplomacy. Now, let me show you exactly what triggered this panic, because what China just did isn't evolutionary, it's revolutionary. For the first time in modern financial history, China has officially authorized the yuan to completely replace the US dollar in bilateral trade settlements with multiple countries simultaneously. We're not talking about experimental programs or limited pilot zones anymore. This is systemic, structural, and expanding at exponential speed. The People's Bank of China announced expanded currency swap arrangements with over 40 central banks. The total value? More than $550 billion in active swap lines. But here's the part that should wake you up. These aren't symbolic gestures. These are operational frameworks that allow countries to trade oil, semiconductors, automobiles, agricultural products, everything without ever touching a US dollar. Russia and China now conduct over 95% of their bilateral trade in yuan and rubles. $0 involved. India, despite being a U.S. strategic partner, has begun settling oil purchases from Russia in yuan, not dollars. Brazil and China completed their first direct currency trade agreement, eliminating dollar intermediation in what's projected to be $150 billion in annual commerce. Argentina, struggling with dollar shortages, just expanded yuan usage for Chinese imports. Even Saudi Arabia, the bedrock of the petrodollar system, has begun accepting yuan for oil sales to China. This isn't theory. This is happening right now, today, at scale. But it gets worse. The cross-border interbank payment system, China's alternative to SWIFT, processed over $13 trillion in transactions last year. That's up 50% from the previous year. The growth curve is parabolic. Countries are connecting to CIPs not because they love China, but because they need optionality. They need escape routes. And when you combine China's currency swaps with CIP's infrastructure and Belt and Road trade agreements, you get something unprecedented. a parallel financial system that functions completely independently of Western oversight. No dollar needed, no SWIFT access required, no exposure to US sanctions. This is the checkmate move. Because once this infrastructure is operational, and it already is, the threat of dollar weaponization becomes irrelevant. You can't sanction a country out of a system they've already exited. Washington understands this. That's why the warnings to allies have become so urgent, so public, and so desperate. Because if allies, not just rivals, begin operating outside the dollar system, the psychological shift becomes irreversible. The dollar's dominance has always rested on one pillar: inevitability. The assumption that there's no alternative. That pillar just cracked. Which brings us to what happened with Canada. And I need you to pay very close attention here because this story has been deliberately buried. Senior US trade officials reportedly delivered an ultimatum to Canadian counterparts that went far beyond normal diplomatic pressure. The message, according to sources familiar with the discussions, was blunt. Any move toward currency diversification, any expansion of yuan trade settlements, any participation in alternative payment systems would be viewed as a direct threat to US economic security. This wasn't a negotiation. It was a warning. Canada, for context, has been quietly exploring exactly those options. The Bank of Canada has studied yuan internationalization extensively. Canadian pension funds have increased their exposure to Chinese bonds, and several major Canadian corporations have begun settling transactions in yuan to reduce currency conversion costs when dealing with Chinese partners. This is rational economic behavior, but Washington views it as betrayal. The severity of the US response reveals something critical. They know the Canadian financial system is deeply integrated with Wall Street. Canadian banks hold massive amounts of US assets. Canadian pension funds are major buyers of US Treasuries. If Canada even begins to diversify away from dollar dependence, it sends a signal to every other ally that the unipolar moment is over. And here's the truly dangerous part. Canada isn't the only ally receiving these warnings. Sources indicate similar pressure has been applied to Japan, South Korea, and even some European nations. The message is always the same. Loyalty to the dollar system is not optional. But pressure and loyalty are not the same thing as incentive. And that's the fatal flaw in this entire strategy. You cannot threaten people into trusting your currency. You cannot bully allies into believing your fiscal discipline is sound when you're running $2 trillion annual deficits with no plan to ever stop. You cannot demand confidence while simultaneously proving you're willing to weaponize the very system you're asking people to remain dependent on. This is the paradox at the heart of American financial hegemony right now. The more aggressively Washington defends dollar dominance, the more it proves exactly why countries should be looking for exits. The empire isn't being conquered, it's being abandoned. And Washington's response tells you everything you need to know. When senior US officials start publicly warning allies, not enemies, not to retaliate, not to respond, to simply absorb economic pressure and stay loyal, that's not strength. That's panic disguised as diplomacy. And those exits are being built faster than most people realize. Because while the headlines focus on stock market volatility, the real crisis is unfolding in the bond market. And the bond market is where empires actually fall. Long-term Treasury yields have surged dramatically in recent weeks. The 10-year yield briefly spiked above 4.6% before pulling back slightly. That's a 30 basis point move in less than 2 weeks. In bond market terms, that's not movement, that's violence. Why does this matter? Because the entire American financial system is built on the assumption that US Treasuries are the safest, most liquid asset on earth. When that assumption breaks, everything breaks. And that assumption is breaking. Here's how we know. China has reduced its treasury holdings to approximately $760 billion, down from over $1.3 trillion a decade ago. Month after month, year after year, they've been systematically reducing exposure. Japan, the largest foreign holder at roughly $1.1 trillion, is now facing its own crisis that may force liquidation. European institutions, which have been the buyers of last resort, are beginning to hesitate. A major European pension fund recently reduced its US Treasury allocation by 8%. That might not sound dramatic, but in the world of sovereign debt, it's seismic, because pension funds don't make rapid moves unless they've fundamentally reassessed risk. And when one moves, others follow. The logic driving this shift is brutally simple. If the dollar is expected to weaken to support trade competitiveness and borrowing is set to increase rather than decrease, then fiscal discipline has been abandoned. Debt expands, confidence erodes, and yields must rise to compensate for increased risk. That's exactly what we're seeing. And it creates a vicious cycle. Higher yields mean higher borrowing costs for the US government. Higher borrowing costs mean larger deficits. Larger deficits mean more debt issuance. More debt issuance means even higher yields required to attract buyers. This is the debt spiral that destroys currencies and nations. And here's where it gets truly dangerous. The United States needs to roll over approximately $9 trillion in debt this year alone. Not new borrowing, just refinancing existing debt at higher rates. Every percentage point increase in yields costs hundreds of billions in additional interest payments annually. The US is currently spending over $1 trillion per year just on interest payments. That's more than the defense budget, more than Medicare, and yields are still rising. This is unsustainable, not in theory, in mathematical reality. You cannot run $2 trillion deficits while paying $1 trillion in interest, while fighting a global trade war, while losing your largest treasury buyers, while demanding allies stay loyal to a system that's clearly breaking. Something has to give. And markets are betting that something is the dollar itself. Now here's what keeps me up at night. And this is the part that most analysts are completely missing. There are 3 specific triggers that will accelerate this collapse beyond anyone's control, and all 3 are already in motion. Trigger 1, Japan's forced liquidation. Japan is facing a currency crisis unlike anything in its modern history. The yen has collapsed more than 35% from recent peaks. Japanese government bond yields have spiked over 30 basis points in a matter of weeks. Absolute chaos for a market known for stability. The Bank of Japan has attempted multiple interventions. All have failed. To defend the yen, Japan needs dollar liquidity, massive amounts of it, and there's only one place to get that at scale: selling US Treasuries. Japan holds $1.1 trillion in US debt. If even 10% of that comes to market in a short window, yields will explode. And once selling starts, it becomes self-reinforcing. Lower treasury prices mean losses for all holders, which triggers more selling. Trigger 2, BRICS currency launch. The BRICS nations are no longer just talking about an alternative currency, they're building it. Reports indicate a digital settlement currency backed by a basket of commodities, and member currencies will be announced this year. It won't replace the dollar overnight, but it doesn't need to. It only needs to provide a credible alternative for the $4 trillion in annual trade between BRICS members and their partners. Once operational, this system will siphon transaction volume away from dollar markets. Less transaction volume means less demand for dollars. Less demand means lower value. Lower value means higher import costs for the US. Higher import costs mean inflation. Inflation means more political pressure for currency intervention, and intervention means printing more dollars, which validates the entire de-dollarization thesis. Trigger 3, the European fracture. Europe has been the silent pillar holding this entire system together. European institutions hold over 40% of all foreign-held US treasuries, but that support is conditional. It depends on the US acting as a reliable partner. Trade wars with European allies, threats over energy policy, demands for increased NATO spending without reciprocal trade concessions, all of this erodes the incentive to remain the buyer of last resort. If Europe begins diversifying even moderately, say reducing treasury holdings by 15% over 2 years, the math becomes impossible. These 3 triggers aren't hypothetical scenarios, they're active processes, and they're accelerating. You cannot threaten people into trusting your currency. You cannot bully allies into believing your fiscal discipline is sound when you're running $2 trillion annual deficits with no plan to ever stop. You cannot demand confidence while simultaneously proving you're willing to weaponize the very system you're asking people to remain dependent on. This is the paradox at the heart of American financial hegemony right now. The more aggressively Washington defends dollar dominance, the more it proves exactly why countries should be looking for exits. The empire isn't being conquered, it's being abandoned. And Washington's response tells you everything you need to know. When senior US officials start publicly warning allies, not enemies, not to retaliate, not to respond, to simply absorb economic pressure and stay loyal, that's not strength. That's panic disguised as diplomacy. What we're witnessing isn't a conspiracy. It's not some coordinated attack on American power. It's something far more devastating. It's the natural consequence of a system that prioritized dominance over sustainability. For decades, the United States has enjoyed what economists call exorbitant privilege, the ability to print the world's reserve currency, to borrow without immediate consequence, to run deficits that would cripple any other nation. That privilege was earned through economic strength, military power, and institutional credibility. But privileges aren't permanent. They're maintained through trust, reliability, and mutual benefit. When those erode, the privilege goes with them. And that erosion is visible everywhere now. Countries aren't just building alternatives to the dollar system, they're accelerating those efforts. Alternative payment systems are expanding exponentially. New trade routes are being established that deliberately bypass US oversight. Economic blocs are forming that prioritize internal stability over integration with Western markets. The financial architecture of the post-World War II order is being replaced, not with something better or worse necessarily, but with something fundamentally different. A multipolar system where no single currency dominates, where regional powers maintain their own spheres of influence, where economic leverage is distributed rather than concentrated. This transition will not be smooth. The dollar won't disappear, but its role will diminish. US living standards will adjust to reflect actual productivity rather than currency privilege. Import costs will rise. Borrowing costs will increase. The gap between American ambitions and American resources will become painfully obvious. The next 3 years will be absolutely critical. Policy decisions made in Washington right now will determine whether this transition happens gradually or catastrophically, whether the US adapts to a multipolar world or fights a losing battle to maintain unipolarity. And here's what terrifies me. I see no evidence of adaptation. I see denial. I see doubling down on failed strategies. I see threats instead of incentives. I see demands for loyalty without offering reasons to be loyal. The empire isn't being conquered from the outside, it's collapsing from within. Because when you build a system on the assumption that you'll always be dominant, and then that dominance fades, you're left with nothing but the crushing weight of obligations you can no longer sustain. The markets are telling this story every single day. Bond yields, equity volatility, capital flows, currency movements. The data is screaming the same message. The only question left is timing. How fast will this accelerate? Which country makes the next major move? Will it be Japan forced into liquidation? Will it be Europe finally walking away? Or will it be a BRICS announcement that changes everything overnight? I need to know what you think. Drop a comment below. Which trigger do you believe fires first? And which country do you think will be the first major ally to openly break from the dollar system? Because whoever moves first won't be alone for long. The cascade is coming. Let's figure out what it looks like together. You cannot threaten people into trusting your currency. You cannot bully allies into believing your fiscal discipline is sound when you're running $2 trillion annual deficits with no plan to ever stop. You cannot demand confidence while simultaneously proving you're willing to weaponize the very system you're asking people to remain dependent on. This is the paradox at the heart of American financial hegemony right now. The more aggressively Washington defends dollar dominance, the more it proves exactly why countries should be looking for exits. The empire isn't being conquered. It's being abandoned, and Washington's response tells you everything you need to know. When senior US officials start publicly warning allies, not enemies, not to retaliate, not to respond, to simply absorb economic pressure and stay loyal, that's not strength. That's panic disguised as diplomacy.